Welcome to part 2. Now that we understand why term sheets are important, let's talk about how to read a term sheet term by term, as well as some of the major pitfalls that I've seen happen again and again throughout my career over the last 15 years. Let's dive in. Now that we've got the basics down, let's go in and read a simple term sheet. A term sheet, especially in the context of startup financing, typically contains several key sections. Each section deals with different aspects of the proposed investment and agreement between the startup and the investors. Here are the main sections you'll usually find on a term sheet. 1. The offering terms. This includes the valuation of the company, the pre-money and the post-money. The pre-money is the value of the company before they raise any money, and the post-money is simply the pre-money plus the amount of money being invested in the company, giving it its post-money. So think about it in simple terms like this. If I say the company today is worth $10 million, and I give them $2 million, then the post-money would be $12 million, because it's assumed that once I made that $2 million of investment in the company, that value didn't just dissipate or disappear overnight or immediately, but it retained its $2 million worth of value. And hopefully the company can take those $2 million of capital and turn it into a multiple of that by the time they raise their next round, and therefore see an increase in the valuation above $12 million. The offering terms also typically include the amount being raised. This is the total capital that the startup is seeking in this round, or that the investors are seeking to invest in this round, and that have been agreed upon by both parties. The next section that you'll oftentimes see within a term sheet are the economic terms. This includes the type of security being offered, such as preferred stock, common stock, and even sometimes convertible notes. It includes the price per share, so the cost of the shares or units of the security being offered. It also oftentimes includes information about dividends and if or whether or not they will be paid out to investors and what they can expect from that. The next section of a term sheet oftentimes includes control and governance. So for example, it might dictate what the board composition looks like, details on how the board is structured and who will have board seats. It may include information around voting rights, so the rights of shareholders to vote on certain corporate matters and what percentage of shareholder votes are required in order to pass certain measures. It also includes protective provisions, certain rights reserved for investors to help protect their investments, similarly to the anti-dilution provisions that we mentioned earlier. Another important section is the liquidation preference. It specifies the order in which shareholders are paid in the event of a sale, liquidation, or winding up of the company, and what they will receive. So in some cases, and the most common, is that investors will receive either the full amount that they have invested, or the ability to convert into common shares and participate based on their ownership percentage in the company. But sometimes you might have more aggressive terms, such as a 2x liquidation preference, wherein the investor will receive 2 times their investment before common shareholders participate, or have the option to convert if they believe that their common shares will be worth more than a 2x. You also have another term called participating preferred shares, wherein they get their 2x or 1x, whatever it might be, and then they convert into common and participate in the upside there as well. So the liquidation preference is a very important term for investors and also for founders to understand. Anti-dilution provisions. These are measures that are designed to protect investors from dilution in future financing rounds. Typically, they include what are called pro rata rights. These are the rights to invest in a future round of financing to protect your current ownership percentage. This is important for a few reasons. One, the game in venture capital is to find really great companies, and when you find them, invest as much as you can in those companies and own as much of those companies as you can by the time that they go public. A pro rata right is really helpful in allowing you to do that. The other reason is some of the rights, particularly around governance and board seats, are often tied to the ownership percentage of that investor of the company. So if they decide not to participate in future rounds, their ownership percentage will drive down over time and may get so low that they no longer are able to have their rights for things like board seats and other voting rights. And so giving them the ability to continue to participate and invest more and guarantee that right in a way also protects other rights, such as their right to a board seat. Number 6, conversion rights. For convertible securities, this includes provisions on when certain things can be converted, whether it's debt into equity or preferred shares into common shares or so forth. Number 7, participation rights. This section details whether investors get to participate in the equity beyond their preference amount in the event of a sale. Redemption rights. These are conditions under which an investor can require the company to repurchase their shares. Now, these don't get exercised very often, but there could be a situation where you invest in a company, it's performing very well, it's very profitable, but never gets to the size that it can go public and struggles to find a buyer for the assets. In that case, as an investor, you may want to have the right to come in and push the company to buy out your shares so that you can generate a return for your investors. Preemptive rights. This gives existing investors the right to participate in future financing rounds to maintain their ownership percentage. Number 10, drag-along rights. These require minority shareholders to join in the sale of a company if the majority of shareholders agree to the sale. This is important because if you find a really great buyer for the company, you don't want some small shareholder to come in and trip up the whole proceeds. You really want to have a smooth, orderly process to get a deal done. Right of first refusal and co-sale agreement. These are the conditions under which shareholders can sell their shares and in some cases allow other shareholders to join in the sale. In the world of secondaries, this has become a more and more important clause to really understand both as a founder and as an investor, because oftentimes a company will be very successful but still take over a decade, sometimes pushing 2 decades before they get to a liquidity event, such as going public or being acquired. And these rights can come into play when an investor seeks to sell their shares early. Number 12, no shop clause. This restricts the company from seeking other financing or sales offers for a specified period of time. An investor has spent a lot of time negotiating a term sheet with you. The last thing they really want you to do, typically, is to take that term sheet and shop it around to a bunch of other investors, thereby pushing to get a better deal from somebody else. After all the hard work that they've done to meet you in the middle, do their due diligence, and get excited about the deal. Confidentiality and exclusivity. These terms relate to the confidentiality of the term sheet and negotiations and exclusivity of the offer. Very similar to the prior clause. Again, just provisions that give the investor the confidence to provide you this term sheet and agree to it in the first place, knowing that you won't go around and shop it around as the founder. Number 14, legal and closing conditions. Legal prerequisites and conditions that need to be met for the financing in order to be completed. These could include we require that an audit is done, or we require that our legal team perform legal due diligence to ensure that all of the legal matters of the company are in a good position. Sometimes it will include some additional due diligence, business-related due diligence on the part of the venture investor, or it may include things like ensuring that a minimum amount of capital is being raised in this round in order to trigger the overall round. Expenses. This details who will bear the legal and due diligence costs associated with the investment. It's not atypical for a specific amount to be allocated towards legal expenses as part of the round. It's not uncommon to see an agreement that $10,000 to $20,000 of the legal expenses of the investor will be paid for by the company as part of the closing of this round. Basically, the investor invests millions of dollars into this round, the company takes that money and pays the investor's legal bills up to a specified amount. Number 16, duration and expiration. So if a startup and an investor agree to terms, those terms typically have an expiration date. You can't just sit there on the same term sheet for years and then hold the investor accountable. Typically, these term sheets are valid for anywhere from 30 to 90 days, just kind of depending on what ends up getting negotiated and the amount of time that's required to perform all the due diligence and other closing negotiations prior to a final close. Let's talk about common pitfalls and what to be careful of. Regardless of what side of the transaction you are on, there are definitely things you will want to look out for. These are 3 of the most common areas of concern that I usually have when I'm evaluating a term sheet and advising and talking to founders. The first one is overvaluation. I feel like this happened a lot during 2021. This occurs when a startup's value is set too high during funding rounds. While it might seem beneficial initially to the founders, it can create unrealistic expectations for future growth and performance. If the company fails to meet these expectations, it may struggle to raise more funds in subsequent rounds as investors see it as a less attractive opportunity. This is crucial to understand and to avoid this scenario because most venture-backed companies require growth on an ongoing basis to keep future investors interested. If you're not able to grow into the valuation that you set because you set too high of a valuation, future investors will look at that and perceive something as being wrong with the business and avoid taking the risk and instead putting their capital into a company that doesn't have that baggage. Number 2, giving away too much equity. This is really the opposite of the prior issue, when the valuation is too low or the founder is giving away too much. When a founder gives away a large portion of their equity in exchange for capital, they risk losing significant control over the company. Investors will oftentimes try to put their best foot forward to help the company. They may not know the right decisions to make on behalf of the company in all cases because they're not running it on a day-to-day basis. This can lead to challenges in decision-making and strategy alignment, and even motivation of the key founders and executives to continue battling it out every day. Startups are hard, and you want to make sure as an investor and as an entrepreneur that incentives are properly aligned, that the founders have enough equity to really feel like they have skin in the game and that they're going to have a meaningful outcome if they are successful. Additionally, if too much equity has been given away early, it might leave little to offer for future rounds or to incentivize future employees. The last one, number 3, is not understanding certain clauses. Term sheets and investment agreements can contain complex clauses and terms. Misunderstanding these can lead to unfavorable conditions for the startup. For instance, not fully grasping the implications of liquidation preference, anti-dilution provisions, or voting rights can result in unexpected consequences during crucial business decisions, exits, or further investments rounds. It's essential for founders to thoroughly understand or seek advice on these aspects to ensure that they are not inadvertently agreeing to terms that could hinder the company's future flexibility or growth. I remember, for example, when I met with a founder who had what's called a full ratchet provision in his term sheet. Basically what it said is that if you raise additional capital in the future at a lower valuation than what we are investing at today, we have the right to receive more shares in the company to make up for that, so that it will be essentially the same as if the investors had invested at that lower valuation. At the time, I don't think the founder fully grasped how important that term was, because sure enough, in a subsequent round, he wasn't able to raise at as high of a valuation. And because of that, his ownership in the company ended up getting severely diluted. He ended up with a much smaller piece of the pie. But more importantly, a lot of his employees ended up with a much smaller portion of the company than they thought, and it was incredibly demoralizing and resulted in a number of his employees leaving the company. It also sent a massive red flag to other investors, which made fundraising even more challenging than it would have been had he not included that term in his term sheet and instead agreed to maybe a slightly lower valuation instead. Now that you know what a term sheet is, go and check the video I made on what is a convertible note. If you're looking for funding, but you aren't sure if you want to give out equity, this is one of my favorite strategies. Go check it out. And always, please like and subscribe if this video is helpful to you. Thanks.